$10 billion for private jets. Apollo is literally buying KKR's leftovers and calling it a strategic pivot.
Leftovers? Atlantic Aviation prints money, Nate. The margins on fueling G5s are absurd.
I know, but with M&A crossing $1 trillion this year, you really think a sponsor-to-sponsor handoff is the biggest story?
When SpaceX is casually moving $250 billion from Elon's left pocket to his right pocket to buy XAI, obviously not.
Precisely, though I'm personally obsessed with McCormick taking a giant bite out of Unilever. The rundown. Over $1 trillion in deals announced already this year, up 27% from last year, and we are just getting started.
Right, and half of that volume feels like it happened this morning. I'm still trying to process the SpaceX and XAI numbers.
$250 billion, the largest deal of the year.
But Nate, look at the structure. It is basically Elon buying Elon. The synergy math on that is just a circle. I want to see the actual cash changing hands here, because right now it reads like pure corporate theater.
Sure, but as a former banker, you have to respect the sheer scale of the paper moving around. Strategic buyers are totally giving up on building AI in-house. They are just opening the checkbook.
Which brings us to a slightly more edible synergy. McCormick carving out Unilever's food business.
Creating a $20 billion flavor powerhouse. Honestly, I love this from McCormick. It is a classic, clean bolt-on.
Not that clean. I was reading the filings this morning. Unilever is still holding onto some straggler brands, and the whispers say that full separation drama is going to drag out until 2027.
Corporate divorces always take longer than you think. Meanwhile, Carlyle is taking a majority stake in MAI Capital Management, valuing it at over $2.8 billion. And Biogen is scooping up Apellis for $5.6 billion.
Good premium on Apellis, but I want to talk about the sleeper deal of the week. Primaris Services dropping $422 million in cash for Pinecrest Electric.
Maya, really? We have a $250 billion space AI merger. Meta is reportedly circling Moltbook. And you want to talk about an electrical contractor?
Yes, because it is a pure data center play. Everyone is distracted by the flashy AI software deals, but Primoris is buying the guys who actually wire the servers. It is the smartest pick and shovel acquisition I have seen all month.
I strongly disagree. It is a massive overpay for a low-margin construction business. $400 million cash is a lot of risk right now.
The margins on data center wiring are completely different than standard commercial builds. Just wait for their next earnings call. I am betting the cash flow is huge.
We will see. But if you want to talk about ridiculous cash flow, we need to talk about private jets.
Oh, the massive sponsor-to-sponsor handoff.
Exactly. Apollo taking Atlantic Aviation off KKR's hands for $10 billion. The big one. $10 billion for parking spots. That's what we're actually talking about here?
Very expensive, highly fenced parking spots with complimentary artisanal sparkling water in the lobby.
Exactly. Apollo taking Atlantic Aviation off KKR's hands for a cool $10 billion. It's easily one of the biggest sponsor-to-sponsor handoffs we've seen all year.
I was looking at the terminal growth assumptions Apollo must be running here. KKR bought this thing just a few years ago, and they're flipping it for this much of a premium? I know the 2026 M&A market is roaring back. We're up 27% from last year, passing $1 trillion in volume. But $10 billion for an FBO operator?
Fixed base operator for those lucky enough to not speak aviation finance.
Right. It just feels like Apollo is paying a peak cycle multiple for a post-pandemic trend. The private jet boom has to cool off eventually.
See, I completely disagree. You're looking at this as a travel business. Apollo is looking at this as infrastructure.
Explain that to me, because I see corporate executives flying less when the economy tightens.
It doesn't matter if they fly less. The planes still need somewhere to sit. Atlantic controls the real estate at over 100 airports. You can't just build a new private terminal at LAX or Teterboro. The zoning laws alone would take a decade. The moats are massive. It's basically a monopoly on tarmac space, and Apollo loves monopolies.
Okay, I'll give you the moat argument. But let's talk about who actually wins here. KKR is walking away looking like absolute geniuses. They bundled a bunch of these locations, squeezed the margins, and are now tossing the keys to Apollo, right as operational costs are creeping up.
Classic private equity pass the parcel. I remember sitting in pitch meetings for these exact types of assets. The deck always claims there are massive synergies in buying jet fuel in bulk.
Wait, really? Bulk jet fuel?
Oh, yeah, we used to put it on slide 4. Total fiction, but it sounds incredibly smart to the investment committee.
That's hilarious. And a little terrifying.
But Apollo isn't dumb. They're sitting on so much dry powder, and institutional interest in hard assets is surging. They need places to deploy billion-dollar checks that yield steady, inflation-protected cash flow.
Even if it means paying a massive premium to your biggest rival. I just hope Apollo actually read the environmental liabilities in the footnotes. You don't want to know what happens to your yield when a 60-year-old underground fuel tank leaks at a regional airport.
I'm sure the lawyers billed an extra million just to look at that exact nightmare scenario. But look, rich people need their jets, and private equity needs its yield. It's the beautiful circle of Wall Street life.
Speaking of feeding the wealthy, we need to talk about what's happening in the grocery aisle. Because buying a parking spot for a Gulfstream is one thing, but carving out a $20 billion food powerhouse is a whole different mess. Voices.
So Wall Street is officially calling it a comeback. Over $1 trillion in deals announced so far for 2026, up 27% from last year.
I read that note this morning. They actually use the phrase roaring back despite geopolitical headwinds, which is a beautiful narrative for a pitch deck, but look at the math.
You always ruin a good story with math.
I just hate when one massive outlier skews the entire dataset. You take out the SpaceX takeover of XAI.
$250 billion.
Exactly. Take out that one absurd $250 billion transaction, and your roaring 27% jump suddenly looks like a rounding error. The broader middle market is practically flat.
Okay, fair point. But you can't ignore what the analysts are saying about strategic buyers. They're completely abandoning the build-it-yourself model for AI and software.
Because building it takes too long. Just look at the gossip right now. Meta is quietly circling Maltbook just to get an AI agent social network. They have the engineers to build that, but buying it saves them 2 years.
And 2 years in AI time is basically 3 centuries. But here's the fascinating part from those same commentator notes. Dealmakers are warning that cybersecurity is suddenly killing these tech valuations.
Yes, finally. I've been screaming about this on this show for 2 years.
You're completely vindicated. Take a victory lap.
I will. It's not just a due diligence checkbox anymore. Buyers are getting under the hood, finding absolute spaghetti code and security holes, and literally demanding a 20% haircut to cover remediation costs.
Which is why I love the old school physical asset deals. No software bugs when you're just parking private jets on a tarmac.
Speaking of which, I'm looking at the footnotes on Apollo's $10 billion check right now. Spill the tea.
I'm telling you, the Unilever drama is turning into a daytime soap opera.
A very, very slow soap opera. They're carving out the food business to McCormick, which is fine. But the whispers about spinning off the rest of the brands, the gossip is that the full separation won't actually finish until 2027.
2027. Do you know how many pitch decks are going to be rewritten between now and then? Every banker in London is going to fund their kids' private school tuition just on the advisory fees for the delay alone.
It's absurd. If you want to rip the Band-Aid off, just rip it off. Don't peel it back 1 millimeter a year while the market watches you wince.
Okay, but speaking of ripping the Band-Aid off, the tech sphere is getting completely unhinged right now. Savvy is prepping a $6 billion swoop for Moonton.
ByteDance's studio.
Exactly, $6 billion. That is a massive flex. Savvy is basically walking up to the VIP section of the club and buying the whole table.
I completely disagree. $6 billion for Moonton right now is an extreme overpay. ByteDance has been trying to offload their gaming assets for months to focus on core tech. Savvy is bidding against ghosts.
Oh, come on. They aren't bidding against ghosts. You need scale in mobile gaming, and Moonton gives them an instant, massive empire in Southeast Asia. It's a strategic premium.
It's a vanity premium. Smart strategy is what Meta is doing right now. They're quietly circling Maltbook.
Wait, Moltbook, the AI startup?
Yes, they want them for their AI agent social network. No flashy $6 billion headlines. Just quietly targeting the exact software assets they need to accelerate their growth, instead of trying to build those capabilities in-house. They looked at the build versus buy math and chose buy.
See, I think Meta is just terrified of missing the next wave. But speaking of massive waves and very flashy price tags, wait until you see the math on this Apollo private jet deal. Tomorrow's radar. I am keeping my eyes glued to the regional banks tomorrow. With all this pressure from stablecoins and fintechs, someone is going to panic buy.
Panic buy is right, but you are looking at the wrong sector. I am refreshing the SEC portal for the Sony filings.
For the rumored TCL deal?
Exactly. A $1 billion home entertainment tie-up. I need to see the footnotes on the IP rights.
Who even buys home entertainment hardware right now? That feels like a defensive play from a decade ago.
Oh, come on. It is an AI data play disguised as hardware. Strategics are grabbing anything with a screen rather than building capabilities in-house.
Fair point. I just hope they scrubbed the cyber risks. Dealmakers are shaving valuations left and right because target code bases are absolute sieves.
Well, with over $1 trillion in deals announced for 2026, up 27% from last year, the bankers can certainly afford the cyber insurance.
And maybe an Apollo private jet. Talk to you tomorrow.